Today I want to talk about the huge margin calls and massive liquidations that are coming. Accountancy firms are preparing for the worst market crash and chain of liquidations ever seen, starting with crypto exchanges and ending with major banks. Today I want to talk about how they're preparing and why. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So I want to start by talking about CZ, the CEO of Binance, being grilled on CNBC about his potentially failing firm.
So do it. Would you be able to handle it if somebody asked you for $2.1 billion back? Would that be okay? Would you be able to still withstand things?
We're financially okay.
Including you have $2.1 billion to give away. If somebody came to claw that back, you'd still be fine?
We'll let the lawyers handle it. We are financially strong.
But thus far, you haven't disclosed your liabilities. And I wonder why that is and whether you will.
Yeah, so we are working with the firms to do the audited financials, liabilities, etc. But the audits don't reveal every problem. So
no, but an audit from a Big Four auditor would reveal that, CZ. If you could get a Big Four auditor to say that, if you're saying that some of them don't want to work with you, that raises questions too. They don't want to work with you because you don't have the files and the data that would make them feel comfortable signing off and giving that stamp of approval?
Actually, many of them don't even know how to audit crypto exchanges. They don't really when they audit, they're very used to auditing a firm.
Does Coinbase, CZ, Coinbase has a Big Four. Coinbase has a Big Four auditor.
Actually, I don't look at Coinbase. We don't really look at.
I think so though.
Now see, this part is really important. CZ basically spent that entire interview being grilled about the solvency of his exchange. He replied saying that Binance is solvent, but he can't find a Big Four auditor to audit his firm because these Big Four auditors don't really know how to audit crypto exchanges. But as the guy from Squawk Box said, actually Coinbase themselves do have a Big Four auditor and have been passing audits over the last few years. It's not that Big Four auditors don't know how to audit crypto exchanges, it's that these Big Four auditors are preparing for the coming market crash and don't want their name and reputation tied to any failing firms. These Big Four auditors don't want to be another Arthur Andersen auditing Enron, and Ernst & Young certainly don't want a repeat of auditing Lehman Brothers before they collapsed. When an auditor signs off on an audit report, they put their name and their reputation on the report saying that we believe this firm is absolutely solvent and absolutely will survive for the next 12 months at least. And obviously these Big Four auditors realise the risk with these crypto exchanges, especially the sketchy crypto exchanges like Binance, and they don't want their name and reputation tied to a failing firm that is about to go insolvent. You may say, Tom, how do you know that? Well, if you didn't know, I actually have a background in accounting. I worked at a big top 10 accounting firm for the last 8 years before starting my YouTube channel. But I do obviously have this 8-year background in accounting, and I've seen a number of accounting firms turn down clients because they know they're far too risky to take on and potentially ruin their reputation for. Back in 2019, Sports Direct, which is the UK's largest sporting retailer, similar to Dick's Sporting Goods or Big Five Sporting Goods, begged the Big Four firms to reconsider their audit snub. These Big Four accounting firms turned around to Sports Direct back in 2019 and said, we don't want to audit you anymore because you're far too risky and could potentially be insolvent, and we're not wasting our reputation on you. Back in 2019, Mike Ashley, the guy that owns Sports Direct, went and bought up a tons of different retailers that were going bankrupt or were already insolvent. Therefore, he'd basically bought a steaming pile of messy excrement, and obviously these auditors didn't want to audit his financial statements because they knew there'd be such a mess. And that is exactly what is happening right now with Binance. These Big Four accountants don't want to audit Binance because they know that it's likely to fail and they don't want to ruin their reputations. And this is exactly how the market crash is going to start with these crypto exchanges and will end up ending with the insolvency of some major banks. On top of that, you may have seen that Mazars, the auditor of Binance, KuCoin and Crypto.com, dumped them all as clients and ceased doing any work for any more crypto companies. As Otter tweeted, he said that the auditor of Binance, KuCoin and Crypto.com dumped them as clients. As usual, the largest red flag is that of the auditor rage quitting. When an auditor rage quits and ceases to take on another client for another year, it's likely because this client is probably sketchy and likely to go bankrupt. We've also seen sketchy crypto firms like Tether saying that auditors don't know how to audit crypto. Binance is also saying that auditors don't know how to audit crypto. However, Coinbase is actually audited by Deloitte, a Big Four firm. I imagine Deloitte audited Coinbase last year because they knew that Coinbase actually had fairly solid financials and weren't hiding any sketchy expenditure and weren't hiding anything sketchy overall. But I really do wonder if Deloitte will renew the audit of Coinbase this year, knowing about the coming market crash. I imagine that even Deloitte will bin off Coinbase as a client because Deloitte won't want to ruin their reputation if Coinbase does go insolvent. And he also said that's why Coinbase's debt trades at such a large discount, because everybody knows the risk of Coinbase going insolvent. Deloitte obviously doesn't want to be the next Arthur Andersen, and Ernst & Young don't want a repeat of auditing the Lehman Brothers just before they collapsed back in 2007, and therefore obviously these big four auditors don't want to ruin their reputations. And right now, moomoo is currently holding their largest ever giveaway for the holiday season. Right now, moomoo is holding a $60,000 giveaway sweepstake, and you also receive 20 free shares worth up to $2,000 each when you sign up to moomoo right now using the link in the description below. moomoo is very easy to use. They don't engage in payment for order flow, which I proved in a video a few weeks ago. They've got tons of technical indicators and advanced trading tools, and it will help you to trade like a pro. You may have seen the outflows from the Binance platform have already swelled to $6 billion. Yesterday this was $3 billion, and therefore overnight they've racked in another $3 billion of withdrawals. I imagine over the next week or two these withdrawals will continue to increase and Binance will end up going insolvent, and that's why they couldn't find a big four auditor to audit their exchange. This will obviously further cause that crypto collapse, and as crypto continues collapsing, it will further cause the stock market to collapse alongside. We're already seeing that in the S&P 500 and in the Nasdaq, as the S&P 500 is down 5% in the last 2 days. And obviously as the wider market continues collapsing, many of these hedge funds and many of these major companies and many of these major institutions and big banks will end up collapsing as well. And to tie it all together, a suspended POS tweeted, he said crypto exchanges failing is a distraction from the bigger problem, the banks. He said banks are over-leveraged to unimaginable highs. He said they need crypto exchanges to be the fall guy so they can blame it on the exchanges if and when the banks fail. I imagine the government will end up looking for a bailout for these major banks and will blame the collapse on these crypto exchanges, kickstarting the overall crash. As Michael replied, he said crypto needs to fall to expose the liquidity issues. He said the World Bank is starting to police crypto, next Binance, and then crypto.com, and the final straw is the DTCC margin call. And what's really worrying and will amplify the overall crash is that many of these major banks still have tons of crypto-based derivatives, and overall derivatives still sat on their books. As Lawrence tweeted, he said, imagine losing money hand over fist, but still having tons of derivatives on your books. As Jan-Jack tweeted, he said, notice that the banks who finance the crypto exchanges Ponzi schemes are all in Europe, which include Credit Suisse, Deutsche Bank, UBS, Barclays, and Eurobank UE. He said their cost of insurance against default is skyrocketing, which is obvious in the widening spread in CDSs, or credit default swaps. We can see the price of credit default swaps for Barclays, for Credit Suisse, for Deutsche, and for Eurobank.UE, and for Hamburg Commercial Bank as well, are all rocketing to new highs. And that's because many of these major banks still have tons of derivatives on their balance sheets, which are going sour. Many of these major banks are losing money hand over fist on these derivatives and on their overall equities positions, and therefore it wouldn't surprise me if one or a number of these major banks end up insolvent as well. And Spence tweeted saying that regulators have been allowing short-selling market makers to destroy the entire market. He said if margin calls were enforced and collateral was met back in 2021, we would already be out of this disaster. And I personally believe this ties everything together and explains how we're in such a significant mess in the first place and why we haven't escaped the current recession and the current market crash. These crypto exchanges and major banks are all tied together, as many of these major banks allowed market makers and crypto exchanges off the hook for margin calls. Back in 2021, especially in January of 2021, a number of margin calls went out, but obviously the DTCC and these major banks simply waived these margin calls. They waived the margin calls because they expected these market makers and crypto exchanges to come up with the cash over the next few days and the problem would be solved. They expected the wider market to rip to new highs in 2022, and they expected retail investors to sell out of their meme stock positions in only a few days. They expected GameStop and AMC to return back to $1 or $2 in only a few days back in January of 2021. Therefore, they expected these market makers and these crypto exchanges to have the cash in only a few days' time. But obviously, these market makers and these short sellers had to double down, triple down, and quadruple down on their short positions in order to push the meme stocks back down. As a result, to do that, they had to sell off tons of their main blue chip stock holdings to stump up the cash in order to use that cash to push the meme stocks down. However, inadvertently, by selling all of their main blue chip stock positions, it ended up crashing the S&P 500. Instead of, in 2022, the S&P 500 rocketing to new highs at 400 or 500 or 600 points, the S&P 500 has so far fallen around 20%. These major banks and the DTCC continued waiving these margin calls, especially as more and more hedge funds lost more and more money on their main blue chip stock positions. And now these major banks are at the point where they're in too deep. If they start margin calling hedge funds now, they're going to lose significant amounts of money, and many of these major banks may end up going insolvent. But obviously they can't continue waiving margin calls forever, because they can't just wave off an entire financial recession like they did back in 2008. These major banks and the DTCC and the US government didn't simply waive the margin calls on Bear Stearns and Lehman Brothers, they actually ended up going insolvent. And that is exactly what's going to happen right now over the next few months as the market continues crashing. To explain perfectly how this works, I've drawn up the capital structure for Citadel. Back in 2020 or 2021 in the early days, we knew that Citadel had around $200 billion. But obviously through 2021, the market rocketed to new highs. I imagine at the end of 2021, they had around $250 billion in blue chip stock positions and in slightly failing short positions. But in 2022, they had to double down, triple down, and quadruple down on their short positions, selling off blue chip stocks and beginning to crash the wider market. Therefore, their overall portfolio value would have begun to fall as the S&P 500 continued falling and blue chip stocks continued falling alongside. Their portfolio value continued to fall as well. Don't forget, Citadel are only using a fairly small position of their overall portfolio to synthetically short AMC. The AMC float is only around $5 billion. Even if the float is sold 5 times over or even 10 times over, that's only $50 billion. That's only going to be a small portion of Citadel's overall portfolio value of $250 billion, and especially when you factor in all of the other short sellers as well, because as a whole, these hedge funds and these market makers are still long on the overall market. And therefore, as the overall market continued falling, so did their portfolio values as well. Now we know that Citadel trades on a leverage ratio of 7-1. That means that Citadel borrows the majority of their money. For every $200 billion that Citadel holds, $170 billion of that is borrowed from external banks. Citadel only has around $30 or $40 billion of their own money, and the remaining $170 billion is borrowed from these big banks. Therefore, back in 2021 and early 2022, as soon as Citadel reached $170 billion in their portfolio value and slightly below, that's exactly when they should have been margin called. These major banks should have sold off Citadel's positions, wound down the firm, and they would have recuperated 100% of their money that they lent to Citadel. But obviously they didn't do that. They allowed Citadel to continue losing money, continue losing more money, and continue losing more money after that. I imagine that Citadel right now are somewhere in this region right here, somewhere between having $100 billion left and somewhere between having negative $50 billion. That means Citadel has lost at least $70 billion of the bank's money and has potentially lost the full $170 billion or even an extra $200 billion of the bank's money that they never actually owned. Obviously right now it's far too late for these major banks to margin call Citadel because they'd have to recognise losses on their books of $170 billion. $170 billion is more money than Credit Suisse actually has. The market cap of Credit Suisse is only $12 billion. Therefore, $170 billion is many times the size of Credit Suisse. And to be frank, right now, Credit Suisse doesn't even have 2 singular nickels to rub together, let alone $12 billion, let alone $170 billion. And this is exactly why we are going to see some of these major institutions and major banks being liquidated and going insolvent as well. When Citadel ends up collapsing, they bring down $170 billion worth of unrecognized losses, which is actually many times the market capitalization of some of these major banks. And that is exactly what accounting firms are preparing for right now, and that's why they're refusing to audit many crypto exchanges and likely many more companies over the next few months. These accounting firms don't want their names tied to failing businesses, and therefore they will refuse to perform audits. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.